It always makes sense to be somewhat skeptical when people say that this time is different, that maybe we will never see a massive bear market in Bitcoin and in crypto in the future. Maybe we just continue to go up consistently from here. And the reason for that is the entities that are currently buying into crypto. Because here's what's potentially different this time. We don't necessarily see any more sell pressure. In the past, we saw the long-term holders dollar cost averaging into Bitcoin. That stabilized the price, made it also rise. And then as the price rose more and more, a lot of short-term holders came into the market, as in the media was talking about crypto. And so people are wondering, should I also jump on this bandwagon? But then as the rally accelerated further and further, all of that supply was held by the short-term holders. If no new people entered anymore, the rally stopped, and then the short-term holders panic sold, creating the bear market. That's what happened in the past. But now things tend to change, maybe. This is the balance of Bitcoin that's held in the ETFs. And the chart for Ethereum doesn't look that different. What I want to point out is that this chart barely goes down. It just continues to go up, while the Bitcoin price during that time period, since the beginning of 2024, definitely did appreciate as well. So net, this entity of the Bitcoin ETFs is not taking profit despite the increase in price. The exact same thing can be said for the Bitcoin treasury companies. This is the number of Bitcoin that's held by the Michael Saylors of this world. This tends to just monotonically increase. There are a few bumps along the road, but in general, this is going up. Again, reducing the circulating supply of Bitcoin. This is supply that won't hit the market anymore. At least that's the argument by the optimists. Now, this cannot go on forever, ever, right? Because at some point the market might be saturated. The entities might have enough. Maybe there's then diversification into other asset classes, or maybe in whatever could be the next Bitcoin, the next hot investment asset class. But here's where I think it makes sense to zoom out a little bit, because both of those charts aren't really that long in duration. And we are making now arguments about the next 5, about the next 10, about the next 15 years. And so what kind of parallel could we draw? Maybe we could have a look at the gold ETF holdings. They also tended to monotonically just increase together with the gold price. But then came a correction in 2012, so 13 years ago, which then 3 years afterwards turned around again. But now we can clearly see that the balance increase isn't as steady anymore as it used to be. And there is the real chance that the same could happen for Bitcoin as well. To a degree, Bitcoin could be seen as a competitor to gold, right? It could be the hardest of the monies. It could be the money that can't get debased. And so that's why I like to study gold data as well. This is the gold Maya multiple. It looks at the current price relative to the last 200 weeks. It gives us timings to potentially buy more and potentially take some profit. Currently, we are high on the Maya multiple, but I don't actually think that this is the best metric to value gold. I think a better metric is to look at gold's price relative to other asset classes. So for example, relative to the fiat currency base. So this is gold relative to fiat. It's a very long-term chart starting in 1959. The dotted line is the average ratio, so the average gold price relative to the money supply. We are above the average by roughly 40%, but we have seen higher prices in the past. So an additional appreciation of 165, potentially even 230%. But maybe even better than just looking at gold relative to the money supply, we can have a look at the S&P 500 relative to the money supply. And that's at historical heights. Again, this chart starts in 1959, and we are at very comparable levels to the peak of the dot-com bubble. Subsequently, we saw the dot-com bubble burst, which of course also had an impact on general stocks, not just on technology stock. We got our slight recovery and then the global financial crisis. And Bitcoin, by the way, was created over here. So Bitcoin never really saw a real crisis. The COVID crash was just a little bit of a blip, but in general, stock prices went up during the entire time of Bitcoin's existence. So gold seems to be somewhat expensive, but stocks seem even more expensive. And so here is the gold relative to the S&P 500 ratio. This chart is even longer term in duration. It starts in 1890. And there's two things I find interesting about this chart. First of all, the magnitude of the volatility from the bottom here to the top here. This is an outperformance of gold of 1,500%, while the crash here from the top to the bottom is an underperformance of 96%. So the volatility here is massive. So that's the first thing I find interesting. The second thing I find interesting is just for how long of a time frame gold and the S&P 500 might just return the exact same performance. This data point over here to this data point over here is 90 years of data. Or from here to here, where we also saw barely any price movement, that's 95 years of data. So this common narrative that stocks always outperform gold, I think is wrong. I think the real narrative should be that there is a shift happening from stocks to gold and from gold to stocks regularly. And that we should potentially rebalance our portfolio every now and then. And if you just look at this chart, I think there's a good case to be made to potentially hold more gold than stocks. So either we are always in a long-term balance, this is in the end 95 years of data, while at the same time, by the way, the US never went through a catastrophic crisis, right? The financial system still survived all those years. Gold would definitely appreciate if there was a massive collapse. But let's work with the assumption that things just go on. Still, gold seems rather cheap. Maybe one could make the assumption that gold actually does underperform the S&P 500 long term. If that's the case, we'd see a loss of roughly 1% per year. Still, I think a sizable allocation to gold is justified, just given how expensive stocks now are relative to the money supply. Stocks aren't just expensive relative to the money supply, stocks are also expensive relative to the future earnings. So when we look at the Shiller PE ratio, right, we look at how expensive are currently stocks relative to the price to earnings ratio. And we again plot this over a very, very long time frame. We have very high valuations. In the end, that's what we do when we buy stocks. We buy the future earnings. So the ratio of the current market cap to the future earnings, that's really the valuation of stocks. And that's that chart. And again, it's extremely high. It's at 40. It's very similar levels to the peak of the .com bubble. Again, Bitcoin got created over here. Had you bought gold at the peak of the .com bubble instead of stocks, you would have outperformed by 800% in the subsequent 11 years. And so what's the argument here? The reason why I show this data is to simply show how important it is to make the right decision between the asset classes. There's too much brain power wasted on trying to figure out what's the next best altcoin, what's the next best stock. But that decision, that micro decision, is actually less important than the macro decision. Where should actually be the capital allocated towards? Should it be stocks? Should it be precious metals? Should it be Bitcoin? That decision is more important. And the thing we should never forget is that we actually do not know what happens to Bitcoin during a real crisis. We don't know if Bitcoin will actually appreciate during the next kind of .com bubble burst. Right now, crypto tends to get traded as a risk-on asset, and risk-on assets tended to go up since Bitcoin's existence. Maybe you've been around at the time, but during the COVID crash, so over here, when stocks fell by 34%, Bitcoin lost more than 50%. So it was traded in a pro-cyclical way, which would indicate that if this ratio suddenly was to fall, if the S&P 500 relative to the money supply was to suddenly crash, maybe this would be very bad for Bitcoin as well. And that's why it's so important, if you have a strong allocation towards crypto, to also have a strong hedge. We still want to take advantage of this expanding market, and yes, this bull run still looks healthy, and there is a case to be made that this time is really different because the type of purchasers that get into Bitcoin now tend to just set and forget. They tend to not sell. But it looked the same for the gold ETFs, until things suddenly didn't look the same anymore. And the current situation with risk-on assets does look very worrying. Have a look at gold relative to Bitcoin. It doesn't seem to be too high. And from the current price, we have seen gold outperform Bitcoin by more than 250%. And maybe we're going to see a breakout like this again. Who knows? Here's the S&P 500 relative to Bitcoin. Again, an argument to potentially sometimes take some chips off the table, at least in the macro. Maybe not today, maybe not this month, but maybe in the next 12 months, there is a potential exit opportunity. If Bitcoin was to hit suddenly 150, 160K, then I personally am definitely going to take some chips off the table. Will I then move that capital into the stock market and speculate that the S&P 500 outperforms Bitcoin? I'm not so sure. Again, I think stocks are very, very expensive historically, much more expensive than gold is. Now, the thing with gold is that a lot of the demand is actually not retail driven, but it's central banks that buy and sell gold. In the last 14 years, we saw mainly accumulation. What I find interesting about this chart is those bumps here, right? Who's buying here during those bumps? That's China. And China seems to have timed the gold market interestingly well. They bought over here when gold still continued to appreciate. They bought the bottom over here, then gold turned around again. And they also bought quite massively over here just before the rally. So maybe it makes sense to just watch China and see what they're doing within the gold market. This chart, by the way, comes from Onchain.com. Now, what could cause this future crash? There is, of course, the idea of the AI bubble crash, that maybe AI companies are currently overvalued. And there is a real case to be made here, because in the past we have seen the .com bubble crash. Even though we still use the internet, even though the internet is as important as ever, we did have overinvestment in the area. And we did see the Nasdaq 100 crash quite a bit. And so something similar could potentially be also said for artificial intelligence. Maybe long term, over the next 20, 30 years, it will be profitable, but maybe short term, we did see overinvestment. But then there's also the looming issue of debt, or how stable is currently the financial system, especially in the US. Now, in US dollars, the debt, of course, always goes up because there's more and more dollars floating around. The US dollar is inflationary. What's more important is the debt to GDP ratio. But unfortunately, this is also going up in the last 45 years. Let's zoom out a little bit more. This is now the US debt to GDP ratio since 1940. And we are at historical heights. And we did see a contraction in the past. So there is a way to potentially turn this around. Now, this is the government debt. Have a look at the red chart here. This is the private debt. So I've got the government debt to GDP at the top. We've got the private household debt to GDP at the bottom. So really, the best way to look at the situation is to just add up both of those. This is now government debt plus private household debt. And this looks really, really ugly. This is now at 190%. So that's 2 years of income. Now, why is that a problem, right? Imagine you've got 2 years of income in debt. You need to pay interest on that. And if the interest payments are very, very high relative to your income, if they increase further and further, then of course, whatever you've got left over isn't that much anymore. And so there is a breaking point, right? If at some point the majority of tax income just goes to serve the interest payments, then there's only two solutions. Either cut the debt, as in default on the debt, or alternatively inflate the currency much, much faster than in the past. Now, what happens when the currency inflates? People look at safe haven assets. And so again, that's the potential case for gold, to have a hedge in gold. No matter where we look, I think having at least 5%, better 10% in gold is a good move. In the worst case of scenarios, we are losing 1% per annum by holding gold over stocks. But I think that's okay, given that stocks are so expensive, relatively speaking, and given that the volatility of the gold to S&P 500 ratio is so massive, that the outperformance can be that large. Again, this is close to 1,500%. There are two ways to think about this. Gold could either just be a diversifier, right? It could be just reducing the overall portfolio risk. If we are now heavily in crypto especially, we might want to have that diversifier because we don't know what happens during times of crisis, and a crisis could be imminent. But the second argument for a gold allocation is to simply have the ability to take advantage of price drops. So if now Bitcoin was to suddenly drop, and we've got some gold that goes up at the same time, we can suddenly buy the bottom. We can buy it much heavier compared to just buying this, say, with our regular income, right? If our wealth relative to our income is relatively high, we need to have a diversifier in order to then rebalance the portfolio, in order to be able to buy the bottoms effectively, because our income isn't high enough relative to our wealth to buy bottoms properly without diversification. But yeah, have a look at this here. This is just a mixed portfolio of gold relative to Bitcoin. It's going up much more steadily. It's hitting very nice all-time highs. This is the last 10 years roughly, and the maximum drawdown we saw was 33%. Compare this with Bitcoin, it's not that much above the prior heights. It only appreciated a little bit since then, and the drops are much more severe, right? More than 70%. Here's the rebalancing argument. Again, this is the S&P 500 relative to gold. We want to be mainly in gold when we are high here. We want to be mainly in the S&P 500 when we are low here. And currently we are high. So I think it makes a lot of sense, especially if you've got a sizable crypto allocation, to actually own more gold than stocks. If half of your wealth is in cryptocurrencies, it's not good to have the other half in stocks. It's better to have the majority of that other half in gold, to have even more gold than stocks. That's my strong opinion. Just looking at the data, right? Just looking at where we currently are and also looking at the correlation. Besides all the medium and short-term price movements, it's also always interesting to see what happens long-term. What kind of assets can we actually hold over the years? Because once we know that, we know what to do during times of potential sell-off. I think, for example, that there's no question that Bitcoin long-term will appreciate in US dollars. Have a look at the percent of Bitcoin supply that has not moved in the last 5 years. This fraction tends to increase long-term over time. So there's less and less Bitcoin that's available for active trading. At the same time, we see more and more Bitcoin getting purchased by the treasury companies, and we've got the ETFs on top of that. So one might argue that roughly 30% of Bitcoin supply is in the diamond hands, or it's completely lost. At least net, this chart is unlikely going to go down significantly. We've got more than 5% in the hands of the treasury companies, and we've got roughly 7% of the supply held by the ETFs. So that means more than 40% of Bitcoin supply is in the hands of entities that tend to just stack away their Bitcoin over time. All of those curves tend to go up over time. They tend to not go down. And again, this reduces supply. This increases the value. Yes, there is Bitcoin mining of 0.83% per annum, but that mining is much slower compared to the rate of lost Bitcoin or of accumulated Bitcoin through the treasury companies or through the ETFs. And so this is where crypto, and especially Bitcoin, differentiates itself from other asset classes. For many other asset classes, we see as prices go up that it's mainly the short-term investor that wants to make a quick buck. But we can see with the Bitcoin rally from recently 16K to above 100K that it's the long-term holders that tend to just accumulate over time that are causing the rally. So that's what we want, right? We want that the people that buy an asset, they're not selling it anymore in the future, at least in aggregate. And this is, I believe, what we see with Bitcoin. And so I don't think it's a real question whether or not Bitcoin will appreciate in the future, especially versus the US dollar, because the US dollar has an expanding supply. It tends to grow by roughly 6.8% per annum. So this is USM2. This is official numbers by the Federal Reserve. If we look at the money supply in 1959 and compare this with the money supply today, within 60 years, the monetary base expanded by 77x, which is an annual growth of 6.8%, which, by the way, is the majority of the return of the stock market as well. Most of the stock market return is just monetary debasement. And so when Bitcoin becomes more and more rare over time because of those entities, and the fiat base grows more and more, then the most straightforward approach would be to simply use the same kind of investment tactics that we have for other asset classes, right? For the stock market, for example, we've got our savings plans, our 401ks, or for property, we've got our mortgage payments, where again, we pay in regularly with our cash flow. We can do the same for Bitcoin. For Bitcoin, it's typically called dollar cost averaging. So for example, if we buy $1,000 worth of BTC, and we do this for the long term, as we do with property and as we do with the stock market as well. if we just expand our time horizon to say 6 years, so beyond a cycle typically for Bitcoin, then it's extremely likely that over time we are outperforming classical investment approaches, because again Bitcoin becomes more rare over time and it still gets more and more adoption. Had you followed this $1,000 per month approach with the S&P 500 or with gold, and you did this for 6 years, you'd be at somewhere around 120, 130k now. Had you done the same for Bitcoin, you'd now be at 360k. So roughly 3x the amount. And so this is where Bitcoin differentiates itself massively from the altcoin market. With the altcoins, we do not know what will be around still in 6 years, what will still be relevant in 6 years. The altcoins are highly inflationary, as in projects issue new tokens over time so that venture capitalists can sell their tokens, so that the team can sell their tokens. There are vesting unlocks. And when we look at the entire market, the entire altcoin market that's tracked here on Tokenomics AI, we've got unlocks of roughly 1 billion per week. So as long as we don't see 1 billion of purchases every single week in the altcoins, the prices of the altcoins are going down. Now, how much is 1 billion per week? Let's compare this with Bitcoin. Bitcoin has a market cap of 2.27 trillion and it's got an inflation rate of 0.83%, which by the way is debatable because again, we've got the purchases by all of those other entities and we've got the Bitcoin that gets lost. But let's ignore all of this. Let's just say this doesn't exist. Let's say we really have a net issuance of those 0.83% on the 2.27 trillion. If we run the numbers, we've got selling pressure of 371 million per week. So roughly a third of what the altcoins have as selling pressure. Now, how likely is it that the altcoins in aggregate get purchased at 3 times the rate of Bitcoin when Bitcoin already has this direct link to Wall Street? I think the likelihood is rather low. On top of that, the Bitcoin market cap is roughly 7 times the market cap of the altcoins. So the selling pressure is only 1/3. The market cap is 7 times as large. So really, relatively speaking, the altcoins have an inflation rate that's 20 times larger. And that's what's causing this situation. This is the smaller altcoins, the performance in the last year. Bitcoin has roughly doubled in the last year. And just have a look at how many altcoins that are shown here have doubled. There's 1, 2, 3 altcoins that did roughly the same as Bitcoin. There's only one outperformer. The rest all massively underperformed. And this is not a coincidence. This is simply just capital concentration towards the long-term winner in the market. You can't buy Quick or Myro or Pika or Atlas for $1,000 every month and just use this as another savings vehicle. Dollar cost averaging into those assets doesn't make sense, but dollar cost averaging into Bitcoin or Ethereum very much makes sense. And so I'm taking advantage of this capital concentration process. I'm betting on most altcoins doing worse than Bitcoin over time. And that's how I create additional alpha over just buying and holding Bitcoin. I don't just dollar cost average into Bitcoin, I dollar cost average into my trading portfolio, and I buy Bitcoin and Ethereum and Solana, and I sell or short sell all the bad altcoins over time. So this is my active trading portfolio measured in BTC. And of course, there is a lot of dollar cost averaging happening here as well. There's additional capital that enters this portfolio every month. But had I not dollar cost averaged at all, then because of my relative valuation trades, I still doubled the money. So without the relative valuation trades, my portfolio would now be only at around 2.5 Bitcoin instead of 5 Bitcoin. That's the kind of impact that's doable after 4 years of following such a strategy. So basically take this DCA approach and just 2x that capital. That's then 720k versus just having around 100k doing a traditional S&P 500 savings plan. Have a look at Arbitrum, for example. This is the number of ARB tokens over time that are circulating. When the supply expands and the demand doesn't expand at the same rate, then the price underperforms. Now this is Arbitrum in US dollars, and this already doesn't look that great, right? We have seen Arbitrum going down by 60%. But compare Arbitrum relative to Bitcoin, it's much, much worse. Again, because Bitcoin has all of those inflows from traditional finance, and because a lot of Bitcoin gets lost over time, and because Bitcoin does not have this ultra aggressive supply schedule. The number of Arbitrum tokens is expanding faster even than the number of US dollars. And that's why it's losing even against the US dollar, but it's definitely losing against Bitcoin. And so my approach to generate alpha out of this is to just flip this chart around. So instead of looking at ARB relative to Bitcoin, here's Bitcoin relative to ARB. So you're going short Arbitrum, we're betting on falling prices of Arbitrum, we're betting on rising prices of Bitcoin. And what we see in orange, this is just the Bitcoin price during the same time. So we outperform buying and holding Bitcoin massively with that strategy. For example, over here, since the beginning of 2024 to today, Bitcoin has appreciated by 164%, but Bitcoin relative to Arbitrum has appreciated by 678%. Now, this is way higher than the alpha that I personally achieve, but of course, I'm also rather risk averse. I don't bet the entire portfolio on a single token, and not everything that inflates as aggressively tends to also lose that constantly. But again, it's all about the long term. It's about building wealth over several years, not just speculating on what's happening next week. Now, granted, betting on relative valuations, so something going up while the other thing is going down at the same time, is a bit more complex compared to just buying an altcoin straight out. But that's why I made dedicated videos on the topic. There's actually only 2 videos that you have to watch. So there is this one over here, using perpetual futures to bet on relative valuations. And there's this one over here, risk management with relative valuation bets. It's 1 hour in total worth of content. And after you've watched that, you know how to set up positions like this. Now, there are bets that are a bit more risky than others. Arbitrum is rather risky. Just have a look at this drawdown here. But there are also more constant winners. For example, have a look at this. This is Bitcoin relative to Balancer. Balancer, again, being a very inflationary token. Here's my offer. You watch those 2 videos, you learn how to set up those relative valuation trades and how to do the risk management properly. And then afterwards, after you've joined the community, I will send you my favorite trade. So I've got several of those relative valuation trades open, but I will send you my favorite one. And if you don't make money with that favorite trade after 1 month of holding that relative valuation trade, then I will just refund you the membership fee. So this video over here and this video over here. And if you don't make money with that favorite trade, you will get the $125 back. That's the fee per month. I of course share every single trade that I make. I don't just share my favorite trade, I share all the trades that I make in real time to the premium members. A link to premium should pop up directly here on the screen. Just click on that, it will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers!